You want to know what are the best stocks to buy now? I've got 5 stocks that I think are attractive at these levels and lower. Let's go. First off, let's talk about what happened to Astera Labs this week.
Let's talk about buttered sausage.
No, not buttered sausage. Astera Labs, Gary.
It's not my gem. I don't buy gem. I buy honey, and I kiss it on the lips.
I promise I'll be serious from here on out. Let's talk about Astera Labs. So as always, there are a lot of moving parts to this, but Astera Labs was down about 13.5% on Tuesday. Why did that happen exactly? Investor jitters following AWS's reInvent announcements about integrating Nvidia's NVLink Fusion into its Trainium 4 XPU setups. Now, there's already a lot of confusion about this because people didn't understand how it impacted Nvidia. For example, one question that I've seen, not only in our Discord, but also on social media. This question's asking regarding Amazon using Nvidia now with Trainium 4. It's not going to launch until 2026. This says December. I think it'll be before December, but it's in 2026. So I assume they'll be working on integrating their own alternative GPUs to try to save where possible. So the confusion here is that AWS is already running the latest NVIDIA Blackwell instances today. It also uses the Trainium chips. The 2026 timeline is for Trainium 4 plus NVLink Fusion. That's when Trainium and NVIDIA GPUs will finally share the same ultra-fast NVLink fabric and hybrid racks for the first time. This is marrying NVIDIA GPUs and Amazon's own Trainium chips together, fusing them together with NVLink. But what this is really doing is it's strengthening the partnership. The risk to NVIDIA with revenue from Amazon, it's modest and gradual, but that TAM is so large. And we already know Amazon's been making its own chips for many years. I mean, we've been talking about this for years on the channel. If you're not subscribed, do that now. Click that bell for notifications. But Amazon's been developing and announcing its own custom AI chips since late 2018. That's 7 years ago. The benefit to Amazon is the margins are lower, 35, 45% less than paying NVIDIA. So one could assume, so right now you're using NVIDIA and you're using Trainium, that Amazon is going to start pushing more of its Trainium chips versus NVIDIA GPUs. But NVIDIA is still going to win because they're going to use NVLink to fuse those together. So on Tuesday, when Astera Labs stock was down, I posted this in Discord and Eric's watch list. This is the benefit of being in our Discord, is I can get you this information in real time as it happens. You can take advantage of stocks when they drop down. But I said that more than likely that selling is because the market doesn't understand this NVLink announcement from Amazon. And I said I'm not worried about Astera Labs. It's mostly traders pumping and dumping. Just wanted to share some thoughts and possibilities that might have enhanced today's movement. It's exactly what happened. So the next day, then analysts came to defense. Stifel analysts here, Torre, buy rating, price target $200. We believe that these fears are misplaced. They'd be buyers of Astera Labs. Morgan Stanley also came out, overweight, $210 price target. The stock sold off 13% on Tuesday because of this NVLink adoption viewed as unfavorable. While in our view, the announcement is clearly a positive. And if you understand this stuff, it actually is a positive for Astera Labs. Of course, sell the news is nothing new in Wall Street, but in reality, the stock should have been up and not down. Of course, you have to look at that stock. It's very volatile. The thing ripped from, I'll show you a chart later, but it ripped an enormous amount, had a 50% retracement. We'll talk about it. But NVIDIA does not compete with Astera Labs. They're partners, not rivals. And even though they do compete with Amazon, they're still partners and they're working together. And there's lots of money to be made, to be won. If you don't know my background, I worked in software for over a decade. And oftentimes we would partner and compete with other businesses. It's very common in the software industry. Amazon's been making their own chips for many years. They're also still using NVIDIA. And this is going to be a common theme. You're going to see ASICs. You're going to see lots of different partners, lots of different vendors, both competing and partnering at the same time. But NVIDIA makes, of course, the GPUs. Astera Labs makes the high-speed connectivity, right? So that lets hundreds of thousands of these GPUs talk together at full speed. This is different than NVLink. So right here, no, NVLink does not compete with Astera Labs. Instead, Astera Labs actively collaborates with NVIDIA to develop and integrate connectivity solutions that enhance NVLink ecosystem. So this is a positive for Astera Labs. This took me 2 seconds to look up on a Grok search. Of course, the market does what it does. It's going to have knee-jerk reactions. The market doesn't understand half of this stuff, and that's normal. A couple days ago, I came out with this Astera Labs DD write-up on Patreon, and I talked about some price targets and some developments that are happening with the stock. So it's actually ridiculous that it sold off because of the NVLink news, but at the same time, the technicals, there's a lot going on with that too. We'll talk about that. Look at a chart. This math is ridiculous though. When I look at this segment here, we're talking about massive, massive TAM in areas that Astera Labs are focused on right now within data center. But this last earnings, you guys know, was an absolute smash. One of the best earnings of 2025. You had 103% actual revenue, a beat across everything, beat on the top and bottom lines, beat on margins, beat on guidance, just a beat. No. Right now, analyst price targets, you got a range. 275 is the high. The low is 155. It's trading right now at 149. Your average is 207. That's about a 25% upside. And actually, the upside's quite a bit more than that because when I wrote that, the stock is actually down since I wrote that. Now, it's interesting. When I wrote that, I told you don't buy it over $150. And right now, it's $148 as I speak. So to get to that $207 price range, I mean, you're talking about more of a 40% upside from here. We'll look at this chart and I'll break it down for you, but $150 or less DCA has been the target, and I'll explain why, and I'll explain where it's going to go in a second. Now, this is what we own in the community portfolio. You can see it's about 5% of that portfolio. It's up 161%. These are house shares, meaning we've already taken a bunch of profits on it. This is what's left, basically free shares. Average cost basis is $63.56. So we actually started buying this stock at the beginning of the year, 2025. And then as it came lower, we bought more. This is March all the way through May. And you can see the different prices in here. Average cost basis anywhere from $59 down to $47.97. We were buying it really like 75 or less DCA. And of course, it got down to $47.13. Now it ripped from $47 all the way up here to $262.90. Now, if you take this bottom number, add that top number, add those together and divide by 2, you got basically $150 is that price level you're looking for a 50% retracement. That's exactly where it's trading right now. And of course, when you do a retracement like that, you draw that 150 level, you draw a circle, that's the middle of it. It can go a little bit lower, and this is just eyeballing it. The 200-day moving average is also down here, so I like this. 125, kind of on this low end, and this is up here at 170. But you can see it came down all the way to about $130 a share. So it didn't quite get to this 200-day moving average. This S2 Fibonacci is 121. You also have an S3 Fibonacci of $95.59. Now, looking at risk reward, you can see the green here and the red down here. Now, of course, the stock can go lower than the S3 $95 because it was just $47 in April. But I think it has a pretty good support area at around $100 a share. And so if I look at this and say risk reward, the downside's probably this S3 at $95. If I'm buying the stock at, say, $145, that's a $50 downside. Now, the upside, this stock was $262. It doesn't mean it has to go to $262. And I can't even draw this down to the current R3, which is $229, but you can still see that risk reward is favorable. I think there's a good chance this stock is a $250 stock in 2026, which is about right here. If you're buying at $145, you've got a $105 upside to that target, $50 downside. Now, of course, if it goes lower, I'm going to buy more shares. The other thing to this too is we're long-term investors, so we're thinking 2, 3, 4, 5 years. Could this stock be a $500 stock, a $600 stock, even higher? It's certainly possible. Now, this is a hyper growth stock. It certainly carries risk. It's a high flyer. It shouldn't have been at $262. This is a parabolic run, a 50% retracement's normal and healthy, and that's where it's at. And you're going to have some buying and selling, some bears and bulls. It's going to find its footing, and it is going to go back this other direction. Could it go lower? Sure, it can always go lower. There could be a negative catalyst. Next earnings could be bad, whatever. The earnings report they just gave us, though, absolutely crushed it. I'm a buyer of this stock, $150 or less DCA, and I believe that this stock will be $225 to $250 in 2026. Of course, this is not financial advice. Do what's best for you and your money. Now, for some reason, you skipped the first part where I talked about Astera Labs. I want you to go back and watch that because it talks about NVIDIA, and it's very important if you're an NVIDIA shareholder to watch that piece. Now, of course, NVIDIA has been under tremendous pressure, primarily driven by Micahel Burry. And you can see all the news out here. Micahel Burry explains why Palantir and Nvidia will collapse. It's going to be worse than Nortel and Cisco in 2000, the dot-com bubble. Micahel Burry just sent a warning to artificial intelligence stocks. Micahel Burry believes that Nvidia is at the heart of the swelling AI bubble, blah, blah, blah. Now, what's comical is Micahel Burry actually started his own Substack. So he's a creator now. And what's crazy about this Substack newsletter called Cassandra Unchained. He started this November 24th, 2025. $39 a month, $379 annually. He's already made between $3 and $4 million just writing and bashing about Nvidia, Palantir, Tesla, and more. Now that $3 to $4 million is per month, may I add. So 80 to 100,000 paid subs at $32 a month, estimating $350,000 to $4 million per month. This is projecting between 20 and $50 million in gross revenue in his first year. And note that he did announce on December 3rd that 5%, not 100%, but 5% of all subscription revenue will go to charity, which will reduce his net by $1 to $2.5 million a year. And then, of course, you got Substack fees. Well, let's just chalk it up as he's going to make a hell of a lot of money bashing stocks like Nvidia. So if you haven't spent a lot of time on this, I want to get you up to speed. His main claim, GPUs become obsolete in 2 to 3 years due to rapid cycles. So when you think of the A100 to the H100 to Blackwell and so on. He also claims that $112.5 in buybacks, $112.5 billion since 2018 offset SBC dilution, but delivers zero owner's earnings value. He's saying it's having true profits. Now, if we want to debunk that just really fast, right, high level, the GPU lifespan is not really 2 to 3 years. Real world data shows that it's more like 4 to 6 years. Depreciation fraud. Standard accounting matches actual usage. Hyperscalers already paid off H100s in 18 months at current rental rates. ROI is real and fast. This is the counter argument to what he's saying. Buybacks and stock-based compensation. Normal for high growth tech. Trust me, I know this. I worked in tech. My wife still works in tech. This is normal to have high stock-based compensation. It's nothing new with software and companies like Nvidia in Silicon Valley. Buybacks aren't zero value and the business is compounding at 100% plus earnings growth. Nvidia's made more millionaires than any other company on planet Earth. .com repeat, saying that this is gonna be worse than Nortel and Cisco and all these different companies in the .com bubble in 2000. No. 1999 fiber had near zero marginal costs after build out. AI has perpetual power plus chip OpEx. Demand keeps growing. Backlog is still years out. Blackwell sold out instantly. And the thing with this lifespan is that other companies, smaller companies, governments, sovereign entities, and so on can use these older chips still. Micahel Burry might be right with Nvidia at some point in terms of it having some big collapse. But it's not going to happen until that AI cycle is done. And we are not done yet. We still have at least a couple of years in that AI cycle. And during that cycle, Nvidia is going to still deliver solid earnings, solid growth, and the stock will go higher. I've owned this stock for a long time. If you follow the channel, you know it. Some people get tired of me talking about it, but it's important because if you want somebody that really understands Nvidia and that can talk to you about it intelligently, I've owned shares since 2017, below $4 a share. Not only that, on this channel, I told you it was a buy in 2019, in 2020, 2021. Every single year, I've told you Nvidia is a buy. In fact, in 2022, I told you it was a must-own stock for any portfolio in any risk tolerance because of the potential that could come from AI. And we've been calling the shots on this, saying it was going to go to 100, to 150, to 175, 200. And I'm telling you right now, this stock is going to be $250 to $300 in 2026. This R3 is $227.75. Right now, you can see that it's finding some sea legs. It's going to pop higher. Once the market noise drowns down, if you really look at the last earnings report Nvidia delivered, it was very solid, absolutely smashed earnings, beat expectations, beat guidance, beat, just like ALAB. No. You might not like it. You might be upset because you missed it. You might think it's a bubble. You might be on Burry's side. The facts are, the reality is this stock is going to go higher. It will be $250 to $300 in 2026 unless something catastrophic happens. Could I be wrong? Sure. My crystal ball is still in the shop, but I've been calling this stock for years and I've been right, and I feel confident I'm going to be right again. All right, what's another stock that is a potential buy at these levels? Now, you've probably seen this in the news. Bids for WBD are in. So Paramount, Comcast, Netflix, who's going to actually win this? What's going to happen? Why would Netflix even want to bid for this? Now, again, on social media, I've seen confusion around this. And anytime you hear acquisition, if there's mergers and acquisitions, M&A, the company that's buying another company, they're paying billions of dollars, the stock's generally going to go down. As a long-term investor, you can often take advantage of that because you can look at it and say, well, what does this actually mean for a company like Netflix if I zoom the lens out 2, 3, 4 years? Now, the thing to note, and the people, I've seen this, people are getting this wrong on the internet, is that this is a cash deal and no legacy cable baggage. So what this means is Netflix is bidding only for the good parts, the studios and streaming, leaving the dying cable networks behind. So why would Netflix even want to buy WBD? The primary reason right here, instant blockbuster IP. We're talking about DC Comics, Harry Potter, Lord of the Rings, Game of Thrones. Franchises that Netflix, they can't build these overnight. And this is also a bigger market share. So Netflix is about 18% market share. HBO Max is 3%. That would give you 21% of US streaming time, pulling far ahead of Disney, Amazon, etc. Essentially, they would be able to bundle this. So most Netflix subscribers, like myself, also pay for HBO Max separately. This would combine them into one bill, keeping users longer, in theory. Now, for me, this is interesting because I get HBO Max free with my AT&T bill, so I have no idea how that would work. But in one move, Netflix goes from lots of originals to owning half of pop culture, and they become almost impossible to catch. And for that reason, DOJ might actually not approve it. It might not happen. It might not go through. And of course, Netflix can still be outbid. So either way, there's a possibility that this deal doesn't happen, and the Netflix stock probably goes up because the people that are worried about spending money and the negative effects of buying WBD, well, that's going to go away, poof, and now people come back and buy the stock. The other side of that, if you're a long-term investor, I think it actually strengthens Netflix's position. So if I'm looking to invest, this really isn't a losing deal either way. Netflix has an A+ profitability, 48%, which is solid considering it's not, technically software, right? This is subscription services for entertainment. Net income per employee is quite high, $745,000 net income per employee. That growth is pretty solid. It's more of a mature company, 15% revenue growth, but very solid. Valuation wise, it's going to have a little bit of a premium for that growth. It's a 41 gap forward PE ratio, which isn't cheap. Now, year to date, Netflix is up about 15.5%. Over the past year, 13%. And it's beating the S&P 500 the last 5 years. The S&P 500 is up right now in the last 5 years, 85%. Netflix is up 106%. You've got a market cap of $440 billion. Could this be another next trillion-dollar company? Probably. Now, looking at a chart, where should you buy Netflix stock? Do I own the stock? Not yet. I'm looking to buy it. I've got an order in. I'm going to tell you exactly what I'm going to do. Now, recently, Netflix did have a stock split. Oftentimes, stock splits can make stocks go higher, but here to remind you, if you take a pizza and you cut a pizza into 20 slices, it's still one pizza. But it does impact what we call pin action. Because if it's $1,000 a share for a stock, if it goes to say $100 a share, where now you can do more options contracts. You need 100 shares per contract. If it's $1,000 a share, that gets expensive. If it goes down to $100 a share, now it's more people doing more options trading, more pin action, more volatility. Generally, in the short term, you see a pop, but usually that fades with time. Now, we are below the 200-day moving average. We're kind of in this trend area where I'd like to buy. This S2 Fibonacci is $100.92. This S3 is around $96 a share. I have an order in the community portfolio. I do not own the stock anywhere at the moment. I've got an order in for $99.97. That would be a starter position in the community portfolio, and I'd be looking to add if it goes lower. There's a chance that it holds up where it's at, $102, $103. Maybe I'll change my mind and I'll pay a couple dollar premium. Not a big deal. I think it's an opportunity here to dollar cost average at $102, $103 a share. When it gets below $100 a share, that's where I think the opportunity is even stronger. And you can see several members have been buying this in our investing trade floor. Not a ton of people quite yet, but a few people have been buying Netflix. All right, let's talk about not buttered sausage, but GitLab. So this is number 4. A lot of people have been asking me about GitLab. Now, I did do a 5-minute video in Discord at the top channel. Go watch that. I'm explaining what I'm doing with GitLab and why. But why is the stock down? Is this an opportunity? And what kind of person or portfolio would be buying a stock like GitLab? Well, the stock was down 15% yesterday. And this really is analysts pointing to Fed and S&B softness. Now, S&B is going to be small and mid-sized businesses. We've had some pressure, especially with government being closed. You also saw some of the jobs data. Jobs data isn't really that good. I mean, overall, the economy is doing pretty well, but there has been some softness in areas. There's some cracks that are starting to develop. Gitlab noted benefit driven by downstream effects of more AI driven code generation, but headwinds from ongoing weakness in SMB, as well as lingering effects from the US federal shutdown. It will also impact Q4. Well, Wall Street cares very much about now and not the future. Generally speaking, they're looking at a quarter out. It's about what can you do for me right now with my money. So if they're telling us that the weakness is going to also be for next quarter, well, the stock's going to be in the penalty box. It's going to be in the doghouse until another earnings comes and says, hey, everything is fine and dandy. So I would expect Gitlab stock to have some pressure until we have some positive catalyst from an earnings report. Now, Wells Fargo, equal weight, lowered price target to 45 from 50. Mizuho also lowered its price target to $47 from 52. Now, Cantor Fitzgerald was more upbeat, reiterating its overweight rating and $60 price target. RBC maintained outperform and $58 price target. Now, you're never going to buy or sell off analyst price targets, but I think it's good to have an understanding of what these analysts think. As I explained in that video on Discord, I bought Gitlab as a fringe play in the main portfolio, meaning it's not something I was intending on holding for 5 years. When I built my blueprint, it wasn't really a core position. I bought the stock because I thought it was undervalued. And I thought I could ride it up to 60, maybe $75, take some profits and move on. So I'm not really a trader, but we often do fringe plays, we call them, and they can be anywhere from 10 months to 24 months, but they're not something that we consider core or part of the main primary blueprint. And so they're going to be something like, 1%, maybe a little bit more. I think it's 1.1% of my portfolio, and I'm down something like 17% on the stock after it dropped from earnings. So I have not added shares, although if it comes down a little bit more, I might add some shares. The reason I'm not adding shares is because I'm trying to de-risk that portfolio. I'm trying to actually take some profits from that main and convert them into my dividend portfolio. That community portfolio is where the growth is focused. But I don't think Gitlab is a great fit for that portfolio. Now, why is that exactly? Well, it doesn't really fit into a secular trend. And I think AI, although it can benefit now, I wonder what that looks like in the future. So Gitlab is not one where I've had a ton of conviction. It's not a super high conviction, pound the table. Again, it's a fringe play where you're trying to buy it at maybe $40, $45, sell it at $60, $75. Now, I think there's a decent chance that this stock does the yo-yo that it's been doing for quite some time. You can see that it comes down here, it pops up to 75 range, drops down to 40, 37, pops up. It really does have this yo-yo effect. So if I look at where the stock's at now, it did break this kind of $38 floor that we kind of have seen. So you can see here, 37.90, 38.80. It did break that slightly. It got down yesterday to about 35 and change, 36 bucks. Trading right now at $37.59. This Fibonacci S2, this is going to be $36.97, basically 37 bucks. S3, 32.30. So there's a chance it could go lower. So what I'm going to show you here is just a tool in the tool belt. You wouldn't just draw one of these and say, I'm going to buy because of this cool graph. It's one tool in the tool belt. And a reminder, guys, that technicals are the last 1%. The first 99% is going to be fundamental analysis. That's going to be qualitative and quantitative analysis. But I want to show you this because it is powerful. So if I look at this and the S3 is $32.30, let's just say that we don't think it's going to really go much lower than that. I actually don't even think it's going to get down here, but let's just say that is the floor. Can it go lower than that? The answer is always yes. But let's pretend that S3 is going to hold at $32.30. This red is going to be your risk or your downside. So if you're buying the stock today at $37.59, you got about a $5 downside right here. Now that R3, and you saw what those analyst price targets are, and they're kind of all over the board. But this R3, when eventually it'll find its sea legs and it'll go up, right? This R3 is $56.76. Now you could have something like a buyout rumor and it can make the stock turn the other direction and go green. That's not a reason to buy a stock, of course. But let's just use this 56.76 as the top end. So your downside is about $5 a share. It's 37.59. you're talking about roughly $20 on the upside to get to this $57 level. So this is the risk reward I generally like. I like 3 to 1 or 4 to 1. So in this case, you've got a 4 to 1. The upside is 4 times greater than the downside. Now, of course, it can always go lower than this. It can always go higher than this. It's just, again, one tool in the tool belt. It's a powerful visual to show you that I think this could be an opportunity as one of those fringe recovery type plays. Now, it's going to be in the doghouse for another quarter. So I wouldn't expect this to rip overnight, and it could take a couple of quarters. It might be something where you might need to hold it for 6 or 12 months to get back to $50. But if say you snag the stock at 35 and it goes to 50, that's a decent profit. I don't want most people buying this stock if it doesn't fit your blueprint, but it's one that I wanted to share and give you some rationale behind because I do own it. I am down. I'm not adding it, but if I didn't own it and for the right portfolio and the right situation, this could be an opportunity to buy. Again, this is a fringe play. Think of it as a fired up wealth version of a swing trade. The fifth stock, Microsoft has been under pressure unjustly. Yesterday, information came out with a report. Microsoft replied, said, hey, this isn't accurate. Remaining performance obligations actually accelerated for AI 51% year over year. Microsoft's dealing with capacity constraints as AI demand is greater than supply. So AI is doing just fine with Microsoft. I think it's an opportunity to buy. Of course, we've already had some, buying since then, but we are still at $478. This S3 is $433. S2 456. This yellow circle, I circled this yesterday in chart day. I think it's an opportunity to add in the circle. Of course, it's a little bit higher. I do think that this stock is going to consolidate and it'll retest this 555 and you'll see it 600 plus in 2026. Thanks for watching. If you're new here, make sure you subscribe to the channel, click that bell for notifications. And if this video is helpful, return the favor, drop me a like, drop me a comment. Have a great rest of your day. Take care.